about a really well, good morning, everybody. I'm really excited to be here today, and thank you to Fenedeco for inviting me. And I'm going to be talking about a really timely topic today, and that's about the 2022 investment outlook and whether inflation is going to derail the global bull market. That's a very important question that a lot of people are thinking about. Now, of course, today's presentation is going to be focused a little bit more towards the US stock market with commentary on the Chinese stock market as well. But with that said, let's get straight into it. I'm going to be walking through some really awesome insights and data points for everybody today. And towards the end, once I finish the presentation, we can open it up for Q&A so that any questions that you have, I'm happy to answer. I'm going to be talking about the macro signals of the strength of the economy. I'm going to walk everyone through what the US Federal Reserve looks at to make interest rate decisions. It's not just as simple as the jobs number. It's not just as simple as how is inflation doing. I'm going to walk you through some other metrics that they do look at. I'm also going to dive into why the supply chain has some really severe bottlenecks and when we can expect those supply chain issues to start to get better. And then finally, we'll talk about inflation and how the latest geopolitical turmoil plays a factor into the inflation outlook for the rest of the year. So I'm going to start off by discussing macro signals. And by the way, later this year, we are expecting some policy divergence between the US and China, where the US is starting to tighten monetary policy, but China has the flexibility to potentially loosen monetary policy. So it's going to be very interesting to see how that dynamic is going to play out as one side of the world tightens and the other side of the world loosens. These two superpowers are going to play a very important dynamic in global inflation. So believe it or not, the Fed looks at a lot more data points than just unemployment and inflation data. They look at everything from GDP to labor market conditions and all of these other factors here as well. They look at unemployment rate, they look at the labor force participation rate, they look at the employment to population ratio, and they even look at consumer confidence as well. So while the media is heavily focused on two factors such as inflation and US employment, the truth of the matter is these two factors have a lot of sub metrics that the Fed looks at. So I would encourage you to pay attention to these sub metrics when Fed minutes come out, when media reports come out, because it's not just these two headline metrics that the Fed focuses on. Now, when it comes to every single Fed meeting that comes out throughout the year, there is usually going to be a dot plot or an assessment of the outlook for the remainder of the year. And that means that this table that is usually released is something that I would heavily encourage you to study because it shows us the Fed's forecast for the change in real GDP later this year, the unemployment rate, PCE inflation, and also core PCE. So when those Fed minutes and when those dot plot projections are released, we can have a forecast of what the Fed is thinking. And every time there is a new Fed meeting, these numbers are going to change. So this table basically tells you how the Fed is thinking about projections every single meeting along the year. Now, I want to walk you through another metric that the Fed is closely paying attention to, and that is the PMI index. And PMI stands for Purchasing Managers Index, and I'll help you understand what that means. It's one of the most used economic data points to forecast future business health. And because of that, economists and analysts pay a lot of attention to the trend of PMI. And I'm going to show you two charts of the US PMI, one from a 5-year perspective and one from a 1-year perspective. And then I'll walk you through China's PMI. So here we've got the US PMI over a 5-year chart, and I'm going to zoom in. And economists and analysts typically agree that that 50 threshold indicates the line between expansion and contraction. So anything above 50 is good. Anything below 50 means that the economy is going into contraction. Now, we can see that since I would say first quarter of 2020, PMI has been on an uptrend, and it actually peaked around summer of 2021. And since then, US PMI has actually been in a pretty clear downtrend. And the reason I want to bring this to your attention is, yes, PMI is above 50, but the problem is it's in a downtrend, and the US Federal Reserve is considering raising rates when potential economic activity down the line will soften. So that brings a lot of considerations to whether the Fed can be as hawkish as the media says they will be, because the data clearly says here that we are entering potentially a period of economic slowdown in terms of growth. So that's a metric that I heavily focus on. And this is a metric that a lot of economists and analysts also focus on. When we zoom in to the 1-year chart, we can see that PMI clearly peaked around the summer of 2021. And since then, it's clearly been on a downtrend. And if the US Federal Reserve continues to tighten into this trend, it's possible that PMI continues to fall and potentially touch that critical 50 level, which, by the way, if it does, is going to be a cause for more serious concern. We're not there yet, but if it does get there, it's something that you definitely do want to pay attention to. Now, China, on the other hand, has seen PMI that's been much more range bound. And we can see that over the last 6 to 9 months, China's PMI has ranged between roughly 51 to 49. So not necessarily demonstrating very strong growth, but not demonstrating any serious weakness either. That said, China's monetary policy going forward is biased towards easing. And so what that means is we can expect to potentially see stabilization in PMI and probably a modest slight recovery down the line. And so when we consider this data in conjunction with the global economy, we have the US Federal Reserve tightening with PMI weakening, and we have China easing monetary policy with PMI stable. We have to factor that into how that's going to play out into inflation and supply chain bottlenecks, which I'll talk about shortly. Now, because of the latest PMI prints and because of the latest weakening consumer confidence, we've seen a very important macroeconomic data point start to become a little bit soft, and that's the US yield curve. And so in any monetary system, there's going to be a yield curve. Obviously, a lot of economists pay attention to the US yield curve, and here's what it demonstrates. We've got the most recent yield curve here in blue, and then these other yield curves represents 1 month, 6 months ago. And we can see that since even 1 month ago, and especially 6 months ago, the yield curve has flattened significantly. And that signals that there is an incoming period of potential slowdown in the economic growth story. So the Fed is paying attention to the yield curve. The Fed is paying attention to the US PMI. The Fed is also paying attention to Chinese PMI and what the monetary policy is likely to be over there as well. So all of this is happening at the perfect storm because of the geopolitical situation happening in Ukraine and Russia right now, which, by the way, I hope is going to get better, because I know that there's a lot of suffering over there, and I wish everybody the best, and hope that the situation gets resolved as peacefully as possible. Now, one of the areas that I also want to walk through is this. As economic growth slows down, as you can see with PMI falling and the yield curve flattening, this is something that you would want to pay attention to, because corporations are going to do whatever they can to protect profitability and protect EPS, which means that with the unemployment rate at 4%, which is a very healthy rate, by the way, okay? That means that we want to pay attention to any macroeconomic softness, because any softness could introduce like a higher unemployment rate as corporations start to lay off employees to stave off that inflation cost structure. So you want to know that inflation is going to be a serious issue when it comes to like the Fortune 500's companies' cost structures. And in order to protect their profitability, layoffs could potentially be on the table in the next 18 months. So that's something that we want to pay attention to. Now, because of high inflation and because of stagnating growth and people not expecting the same kind of income growth that they experienced in the past 18 months, we can see that consumer confidence has fallen pretty significantly year over year. And all this paints a picture where the Fed can tighten and they will tighten, but I just don't really see them being as hawkish as the media says. The media says that they could hike up to 8 times, 9 times this year. As you'll see later today, I'm going to show some evidence that I really don't think that is a likely outcome. Yes, will 4 rate hikes, 5 rate hikes be will be a reality? Most likely, but I think anywhere from 8 to 9 rate hikes that the media talks about, I think that's a little bit too aggressive, and we'll talk about that. As you can see, the economic data doesn't necessarily support such a hawkish stance from the US Federal Reserve. And given that 70% of US GDP is tied to consumer consumption, and we can see that consumer consumption is not necessarily on a trend, that is a data point that continues to pressure the Fed to not necessarily be as hawkish as the media claims. Now, there are some wild cards in the macroeconomic equation, and that is commodities, because commodities drive a lot of headline inflation. Commodities drive a lot of headline inflation, and the truth of the matter is Russia produces 10% of oil global usage, and much of that oil is shipped through Ukrainian pipelines. And given that oil at $100 or above would continue to make the inflation situation worse, this is the wild card that I would say that has the potential to make the Fed not focus as much as they want to on consumer confidence, make the Fed not focus as much on the yield curve and act because headline inflation is directly being impacted by oil. So this is one of the major variables that I'm closely watching, because even though the US is going through a period where growth is starting to taper off, commodities and the recent price spike could cause continued headline inflation, and that could force the Fed's hand. So I would say the US Federal Reserve is in a really, really challenging situation right now. Now, that said, with oil extremely elevated, I would say that any kind of peace agreement between Ukraine and Russia, any kind of walking back on the hawkish military rhetoric is going to make oil have a significant retracement. I know a lot of analysts are calling for $130 a barrel, $150 a barrel. Now that can certainly happen, but when we think about the technical setup, when we think about the fundamental setup of oil right now, it's all being driven through geopolitical risk. And because of that, these prices are not fundamental prices. And I want to write that down here. These are not fundamental prices. And because they're not fundamental prices, the moment the geopolitical situation changes, the price is going to readjust very quickly to that. So one can only hope that peace is achieved in the Russian-Ukraine situation, because if not, geopolitical risk can take the price of oil substantially higher. But if things calm down, then prices will normalize pretty quickly. So it all depends on exactly like what happens in the Russia-Ukraine situation, which of course we all hope is going to find a more peaceful resolution than not. Now, I want to take a moment to talk about the supply chain. I want to take a moment to talk about inflation. I think you guys will really enjoy this, because up until, I would say, the fall of 2021, I have to admit that inflation was driven by both demand and supply. I'm going to write that down here. Was driven by both demand and supply. The demand coming from all the stimulus that US consumers received during the pandemic, and then the supply chain issues being caused by all the bottlenecks, which I will explain shortly. Now, the truth of the matter is, I would say that since the fall of last year, inflation has been more of a supply side driven story than a demand driven story. So yes, while inflation and its rise in the first part of 2021 was caused, I would say, by both of these factors, strong demand and strong supply, I would say that starting from fall of last year, it really has been a supply chain story rather than a demand story. And the reason I can prove that to you is we can see that the consumer confidence that I laid out in the last several months, the year-over-year change, and we can see the chart here actually, we can see that consumer confidence has weakened quite a bit in the last 9 months. This doesn't necessarily paint a picture that inflation is demand driven. And also when we look at the PMI that I showed you earlier, the 1-year chart having tapered off since the middle of 2021, and since then it's been on a relatively downward trend, that does not paint a picture that inflation is demand driven. So previous to that, yes, I would say inflation was demand driven between, I would first quarter 2020 to mid 2021, but since then it's been primarily supply driven. We can see it in PMI, we can see it in consumer confidence, we can see it in the yield curve as well. So what does that mean? In order to understand inflation, we need to understand the supply chain. And once we understand the supply chain, we are going to have a much stronger idea of where inflation will go from here. So let's talk about one of the most important policies that influences global inflation, and that's China's zero COVID policy. This policy that you probably have read on the news, most economists, they focus on the zero COVID policy in terms of what that has to do with the spread of COVID, the containment of the variant Omicron. The truth of the matter is, this policy is one of the biggest, I would say, catalysts to supply-driven inflation. And I'm going to explain why in just a second. So you want to understand that the moment that this zero COVID policy in China is starting to loosen up, is starting to walk back, and we don't know when that will be. It could be later this year, it could be next, right? But once this policy is walked back on, and once this policy is starting to be a little bit more flexible, we are going to see the supply side driven inflation start to really come down. And that's when global CPI, that's when the inflation numbers that are really scaring a lot of consumers, that's when things are really going to get a lot better. So let me explain to you why that is the case. So first of all, as we know, China controls a lot of the ship trade routes throughout the world, but I want to walk you through this map here. And these are the 4 major ports in China: Tianjin, Dalian, Shanghai, and Shenzhen. And a lot of the world's global trade happens in these 4 trade ports. That's where a lot of these exports start to, ship these goods to North America, Latin America, Europe, okay, the African continent. And because of China's zero COVID policy, there's a lot of restrictions at these ports. There's a lot of restrictions. And what I mean by that is, if there are COVID cases, even like just a number of COVID cases, a handful of COVID cases that are, open at these ports, China actually has regulation to really re-examine all goods, really re-examine all workers, and that slows down the global supply chain. And so these restrictions place a significant burden on global trade. And that means that once these restrictions are starting to loosen or lifted in the future, then global trade will resume, and that will bring supply side inflation pressure to a much lower level than it is today. So there is a lot of data points that points to potentially inflation having peaked in this period of time. I know we probably will see higher CPI figures in the coming months because of the price of oil, but if we exclude oil and if we exclude energy from the calculation, I want to show you some really cool data here. And this is a company called Triton. Not a lot of people follow this company. Not a lot of people have heard of it, but it's pretty important. And here's why. It's one of the world's largest container leasing companies. Now, before I continue, I want to explain to you what these containers are. Here is a shipping container. And inside the containers, these are the goods that get delivered into our retail stores when we go shopping. It gets shipped from Asia typically, and then it goes to the ports in North America, Latin America, Europe, and then from there it gets shipped to warehouses, and then from warehouses it gets shipped to the stores. Okay, and so Asia is usually the starting point of trade, and then once these containers are finished being deployed, they get shipped back to Asia, and that process continues again. Now, this company is the world's largest container leasing company. And here is some really encouraging data points. And this was fairly recent. Believe it or not, last year in containers, there was a very, very big shortage. In other words, there weren't enough of these containers to ship goods around the world. So if we think about this from a really simplistic macro perspective, when I said, yes, a lot of the issues are supply driven. Well, what's causing the supply issue? Well, there weren't enough containers to actually deliver all the goods that were demanded in the bulk orders. And for that reason, that was a major catalyst for supply side disruptions last year. Here's the thing. These containers, the shortage is no longer a limiter for global trade. And what that means is there were a lot of manufacturers last year that were rushing to produce more containers so that that shortage would have been eliminated. And that's since been solved. So here's some more commentary from the CEO of this company. And I'm going to read this here. And I'm going to start from here and then I'll end here. So he said, in terms of market dynamics, from July 2020 to around July, August, September 2021 was one of the few periods I've seen in my 23 years when container supply was the overall limiter of global trade. So in other words, even though most media outlets didn't talk about it, one of the reasons that there was that big supply chain issue was there simply weren't enough of these containers, but that's been fixed. And now that we have one variable in that process fixed, we are on our way to fewer supply chain disruptions. So we can see here that we are in a situation where the market is still tight and we are still effectively at almost 100% utilization, but it is no longer a fact that every container a shipping line gets means one more cargo load they can take. In other words, that constraint that was present last year is now not as severe this year. So when I think about how to assess the supply chain congestion, I try to make it as simple and as logical as possible. So when I walk you through how the shipping routes work, where we first start off with the 4 ports in China, then shipping to the various trade routes along the world. Well, if we think about how this plays out in simple terms, that really means that we have really just several factors. And of course, there's more, but here is a really powerful foundation to understand the supply chain congestion. So I'll walk you through the shipping containers. There was a shortage last year, no longer the case this year. And of course, then it's the ships, right? I'm going to try to draw it. I'm not a great artist, but I guess that's the ship, okay? Here are the ships that have to, navigate from Asia to North America, Latin America, Europe, and then the inland logistics. So in China, there is that zero COVID policy. And then in the US, there are ports that are still quite congested because of a lack of labor forces that are willing to work those jobs, and there aren't enough staff to work those roles at US ports. So inland logistics plays a major role in addition to vessel ships availability, and also shipping containers. So when we think about the US and the major ports, yes, there are many ports where goods can come in, but really the biggest ports that I monitor are the Long Beach, Los Angeles port, and the New York and New Jersey ports, because most of the trade on the West Coast, most of the trade on the East Coast, the goods, they come to these ports. So we can actually monitor some important data points here. And this is the number of ships waiting for the LA, okay, Long Beach ports, meaning these are the number of ships that are essentially idle at these ports and not being able to be docked because there's a staff shortage or there's another congestion issue. So watch this. Since the mid 2021 time period till I would say the beginning of this year, there were a lot of these ships. I'm gonna draw them. Okay, there were a lot of these ships that were essentially waiting to have all their goods docked at the Long Beach, Los Angeles port, and that caused a lot of supply chain issues. So many ships were just waiting at the ports and not being able to be unloaded. That's why during this period of time, what did we see? We saw CPI rise substantially. We also saw headline inflation, core PCE also rise. And that is caused because of this supply chain issue here. Now, what we can see lately is that since the end of January, we have started to see the number of ships waiting at the docks start to decline. And that means that if this trend continues, the supply chain issue is going to slowly get better. Now, is it structurally going to still be an issue? Will it take time? Yes, it will. But if this trend continues to reverse and the number of ships waiting at these ports are no longer as congested as it once before, then objectively, things are going to get better than where they were just 6 months ago. Now, once again, here's what shipping containers executives are saying. You know, one reason for this supply chain issue is that there was a big boom in bringing stuff in. There was all this stimulus from the government. Real disposable income was going up, as we can see, right? PMI, it was very clear over here. Stimulus really did a powerful impact on the economic growth story. But since then, because stimulus is now over, we see that reflected in consumer confidence. We don't see stimulus anymore, and we have real disposable income falling and real disposable income factors in inflation. So because we have real disposable income falling, we've got the demand side of inflation not necessarily having a very strong case, and we've got the supply side where you can see that the number of ships is starting to clear the ports, and we have potentially China's zero COVID policy being a little bit loosened later on this year. We don't know when. It could be later this year, it could be next. But once that policy is lifted, the supply chain issue is also going to not be as severe, and therefore it will take a while, but CPI is definitely not going to stay at this elevated level over the next 2 years. It's going to retrace. I am betting on lower inflation in 2023 rather than higher inflation in 2023. Now, of course, this means that, you know, we can't see oil at $200 a barrel or something very crazy like that. If we see, you know, oil at $200 a barrel, then everything that
Mr. Cheung, sorry to interrupt you. When you say you bet on a lower inflation in 2023, do you put it in between the Fed's target or slightly above, but it's still not as high as we have it today?
It's going to be above their target. It's going to be above their target, but it's not going to be as high as it is today. Yeah. So right now, CPI headlines is 7.5%. By 2020, sometime in 2023, it will be above the Fed's target, but I don't see how inflation can be this high next year, given that demand is softening and that supply chain issues are starting to work itself out in the background. Now, the one variable that could invalidate everything that I just said is if oil and commodities just explode because of the Russian-Ukraine geopolitical situation. But absent that situation, inflation in 2023 is very likely to be lower than where it is today. It'll be higher than the Fed's natural target, but it's going to be lower than where it is today. That's my conviction. Now, in terms of the market outlook, it's very scary right now. A lot of people, a lot of retail investors, especially, they find today's market environment to be quite dangerous, and rightfully so. We have the VIX, which is an indicator of volatility and an indicator of the variance of price movement being relatively elevated at approximately 30. So for your reference, the VIX is a data point that measures sentiment in the market. It's a measurement of fear. And when fear is high, so is variance. So when fear is high, so is variance. And when variance is high, price swings are large. So historically speaking, the VIX stays structurally under 30, like I've showed you here. Historically speaking, the VIX stays structurally under 30. And today it is around that 30 level, perhaps somewhat above it, perhaps somewhat below it, very, very close to 30. And longer term, the VIX does not stay at this elevated level. It could stay at 30 for a period of time, but when you have a longer time frame, it's just highly unlikely that fear is going to stay elevated at this juncture for an extended period of time. For that reason, on YouTube publicly and in my investment community on Patreon, I do express a fact that once fear fades, it's very likely that 1 year from now, we see equity prices higher than where they are today, in spite of the interest rates hikes that we're going to see later this year. So that's that. Now, this is a data point that I also pay attention to, and perhaps this is even more important than the VIX itself. This is what I call the high yield credit spreads. And the high yield credit spreads, they measure default risk. And default risk is just a fancy term of saying companies that cannot pay back their interest and their principal. And when this chart spikes higher, that indicates that there is a higher likelihood of credit default risk. But as we can see, the credit default risk continues to be relatively stable at historical lows. But we are seeing, if we zoom in, we can see that high yield credit spreads are starting to tick up from the very lows. Is that a cause for concern? Not today, but that is something that I'm monitoring, because if credit spreads are rising too much, that is I would say that's a very negative leading indicator for the economy. For now, it's under control, but that is something that I'm closely watching. This is a very important variable here. We do not want this number to creep higher, because that means that the default risk is also rising. Okay, so that's that. Copper prices are an area that I monitor. It indicates that global growth and production is still steady. So for now, this commodity is indicating that the global outlook, it's not going to deteriorate substantially, but it's also not going to re-accelerate that heavily in the coming months as well. Okay. Now, despite all of this, I would say negative news, consumer confidence falling, PMIs falling, the US yield curve flattening, and the geopolitical situation, there is a silver lining. And the silver lining is that the Fed is paying attention to all of the worries in the world right now. The Fed is very closely paying attention to that. The Fed is paying attention to Russia and Ukraine. The Fed is also paying attention to the stock market volatility lately. And in their latest Fed minutes, the Fed is ready to raise rates, which I think is a good move. They have to get started. How they do so is more important than getting started. So I see that the Fed is likely going to raise rates by 25 basis points in March. And later this year, they'll have more room to do so, but I just don't see them being as hawkish as the media says. They continue to say that rate hikes would be data dependent and that the balance sheet runoff would significantly accelerate in the third quarter. And all their language, it impacted long-term yields, far real yields, and also, mortgage-backed security spreads being widened. And the Fed continues to say that they're going to adjust the details based on economic developments. So they are paying very close attention to the data. They're not just looking at inflation. They're not just looking at the jobs number. Those are very important data points. And those are the data points that most people focus on, but those are not the only areas that they focus on. So the producer price index is another indication that inflation, yes, it's structurally elevated, but because we have the producer price index making a local top here, it's likely that inflation is going to stay elevated, but it's going to start flattening out, and its year-over-year growth is going to start flattening and plateauing. And that's good news, because once the supply chain issues are resolved, that means that later in 2022, 2023, we're going to see inflation start to taper off. So it is the perfect storm to tighten monetary policy right now. The Fed is in a really difficult spot. But with that said, I'm going to help you analyze and understand that, yes, the Fed is going to raise rates, but not necessarily as hawkish as the media likes to say. So there are 12 voting members of the FOMC. 7 of them are board of governors, and 5 of them are presidents from the 12 Federal Reserve banks. So here I've got that list, the committee members and some of the alternate members, and starting from Fed Chief Jerome Powell all the way down to Neil Karkashi from the Fed chief from Minneapolis. Now, what I've done is I have analyzed their views ahead of March, and these Fed leaders, they make statements publicly distributed on Wall Street Journal, New York Times, Bloomberg, and of course, not every single one of their commentary was able to be located, but for every Fed leader who has a say in the process, I was able to analyze and understand what are their views ahead of March. And while we might have seen, James Bullard be specifically hawkish, calling for these 50 basis point hikes, the truth of the matter is most Fed officials are not really supporting a 50 basis point hike. So when you read the news, I would say that James Bullard gets a lot of media attention. He gets a lot of media attention. And the reason is his view is the most hawkish. He gets a lot of attention, his views are the most hawkish, but if you really study the whole landscape, if you really understand what other Fed leaders are saying, most of them are against that 50 basis point hike. So when the market was very concerned about that, that's something that I discuss on YouTube. That's something that I discuss inside my investment community on Patreon, that yes, the media is showing what he's thinking, but the media is not focusing on what other people have to say. And he's just one Fed committee member out of 12. So I want you to think about that. I don't want you to just read headlines and be convinced that the Fed is going to do a 50 basis point hike, because he was one of just a couple Fed leaders who supported that stance. So the number of rate hikes that are being forecasted by the banks, 6 to 7, I would say that is that's quite aggressive. I think that isn't necessarily going to be a likely outcome. I think more likely than not, we'll probably see 6 as a max, but we could see anywhere between 4 and 6. I really don't think that 7. I really don't think that 7 rate hikes this year is something that is likely to happen. So that's that. So in terms of my opinions on what happens next, I do believe that in 2023, inflation is going to calm down. It's going to stay elevated, but it's going to calm down. So the chart's going to look like this. It's going to be structurally elevated, but it's going to calm down. Consumers aren't going to be as nervous about inflation next year as they are this year. That's my view. I also view the US stock market favorably, especially at this price point. I do believe that once geopolitical worries are at bay and the Fed's views are much more clear to the market, I do believe that I do not believe that the S&P 500 has peaked. I believe that the global stock market will continue and resume its upward trend. And in terms of where the Chinese stock market is likely to go, this is a little bit more challenging to forecast because there's a lot more politics that are involved with Chinese stock markets. But I would say that President Xi Jinping is a lot more focused on growth this year because he is going to be reelected later this year. And so for that reason, because he's a little bit more pro-growth this year, he is a little bit more biased towards easing monetary policy than tightening. I also do see major companies like Alibaba and Tencent making a comeback in the second half of this year. First half of this year will be tough for these sets of companies. Sentiment is still down, investor positioning and sentiment is still very weak and against Chinese equities. But in the second half of this year, once China does monetary easing, and if they show any signs of letting up on the zero COVID policy, it's likely that we see a much stronger stock market in both US and China towards the end of this year compared to where it is today. So with that said, I'm happy to take any questions. I know you probably have a couple of questions. Inflation and the economy is definitely something that's on a lot of people's minds. So I'm happy to take any questions, and I hope you enjoyed this presentation.
Yeah, well, I think we all have enjoyed this presentation, and I would like to ask you first this. When you show us like the people who's taking the decisions about rising interest rates and in the Fed, I've seen that there's there's no consensus. So that brings me to ask you this question, and it is, well, at least they agree that there's a need for hiking a bit the interest rates, or do you still believe they are not reaching any kind of agreement, like, to put it forward?
Okay, so if I understand your question correctly, you're asking me if the Fed has consensus on raising rates, is that right?
Yeah, that's basically it. Is there a consensus on raising rates? Well, not specifically by how much basis points, but at least if they all agree that they must raise interest rates.
Okay, yeah. So here's how I'd like to answer that question. So March is the first meeting where they're going to decide on liftoff, and then we've got rest of the year. So here's my analysis so far. For March, it's almost unanimous that a 25 basis point hike is coming and that a 50 basis point hike is off the table. For the rest of the year, it's far more divided. So to answer your question, in terms of what the Fed leaders are thinking for the rest of this year, there are several of them who believe that 3 to 4 hikes are appropriate. There are several other Fed leaders who believe that 6 or 7 hikes are appropriate. So when it comes to the March meeting, it's essentially going to be a 1 hike story, like a 25 basis point hike story. But for the rest of the year, it is very divided, and that's what makes a market interesting, because everybody has essentially decided on the outcome of March, but the rest of this year, it's still very much on the table. Things can change. The Fed is going to be looking at these data points that I walk through every single month, these points here: quarterly GDP, labor market conditions, of course, CPI, non-farm payroll, labor force participation rate, employment to population ratio, consumer confidence. They're going to be looking at a range of data month over month. And so I expect, because the Fed is so divided on the policy later this year, the market is going to treat every single economic data point really seriously. So it's in March, there's no debate in terms of what's going to happen. The rest of this year, though, is up to debate. And because of that, that means that every month when the jobs number comes out, every month when the consumer confidence number comes out, every month when the PMI comes out. Like these economic data points, which used to not move the stock market as much, will be a lot more important to the market later this year. So I would say for the rest of this year, after March, it's going to be meeting dependent. Hopefully that answers your question.
Yes, yeah, it actually does. We have Juan Jose who would like to ask you a question. Go ahead.
Thank you. Hello.
Hello.
I have a question, and it's from the peak in January 2020 to today. There has been a rise of 33% approximately of the S&P 500, and I don't know if you really think that there has been from 2020 to 2022 a 33% improvement in real economy. So I don't know if I see that you believe that U.S. markets will still rising, yeah. But you don't believe in a correction? Don't you think that there's something to do with inflation and stock market? Where that money come from? That's my question.
So if I understand your question correctly, it's since January 2020 to today, there's been a 33% appreciation in the S&P 500, but there isn't necessarily a 33% growth in the economy. And so you're asking, is that sustainable, and why is that the case? Is that your question? Yeah, okay.
Yes, thank you. And that maybe that is related with high inflation.
Okay.
That's basically.
So one of the ways I like to answer this question, because I do get it a lot, is I look at the S&P 500 in terms of its top 10 holdings. So the S&P 500 is an index that contains 500 large cap companies. And in the top 10 holdings, we got companies like Apple, Microsoft, Google, Facebook, Nvidia, Berkshire Hathaway, JP Morgan, and what else? Tesla. That's right. So these companies, as you may well know, they have all, except for really Facebook, they've all done really, really well. And why is that? Because in the US, we don't call them monopolies, but they're essentially monopolies, right? They're essentially monopolies. Like, we don't call them monopolies, but they are. They have no competitors. They have no competitors. And these companies, they are roughly 30% of the S&P 500. So because these companies have such a big weight in the S&P 500, and they're essentially monopolies, and so their revenue growth is essentially unstoppable, that nothing stops them from continuing to grow and eat more of the market share in the pie, these companies have done very, very well. If we look at many of the other S&P 500 companies, a lot of them are actually not that far away from January 2020 levels because of the recent tech correction, the recent correction. The mega caps have done very well, but a lot of the other companies inside the S&P 500 have drastically underperformed the index. So the 33% appreciation from the S&P 500, essentially a majority of that move is from these companies. And so these companies represent that major appreciation from the S&P 500. So for that reason, we can't look at the S&P compared to the economy, because the S&P is too driven by these mega cap names. And even though the economy has not grown at that rate, the S&P 500 is likely to stay at these levels or continue to rise because it's these companies that drive the index forward, and not necessarily like some of the smaller names in the index, which have not done as well as these mega cap names. So that, I hope that answers your question. It's not that the economy in the US has been phenomenal. It's not that the economy in the US has been great. It's because these companies, which are essentially monopolies, they have really been dominating in the last 18 months. Investors have rewarded their share price, and that's lifted the S&P 500. It's not the economy lifting the US S&P 500. It's these 10 names, 10, 15 names.
Thank you, Larry. Thank you very much.
Okay, Mr. Cheung. So we have Johan who would like to make a question also.
Okay, thank you. Congratulations first. I think it's a very good presentation, and once again for FENADECO, my thanks for so much.
Pleasure.
Yeah. ¿Sí me escuchan o no?
Oh no, I said my pleasure.
I'm sorry. Okay. You conclude with the behavior on inflation in China and the United States. This is related to the rest of the world. Will they be similar behaviors? I ask this because I love data, but I don't know about nothing in economics.
Okay, so if I understand your question, did you ask me, do U.S. and China inflation rates reflect what's happening in the rest of the world? Is that your question, or is
Yes,
the question?
yes, yeah.
Okay, yeah. So believe it or not, I would say that there are other factors when it comes to emerging markets, and here's where I don't want to overstep my expertise. My core focus is the U.S. economy and China's economy. I'm not necessarily a emerging markets specialist, and so it's hard for me to comment on inflation outside of these two core markets that I focus on. I'll give you a general idea what I think, but by no means am I an expert in emerging markets. So I do think that emerging markets and inflation have different dynamics compared to the U.S. and China, and that's because of currency, and also because of local GDP. And I'm also aware of the fact that monetary policy in emerging markets are a lot more hawkish than the policy here in the U.S. I know, for instance, that central banks around the world have already hiked numerous times in the last 6 to 9 months. So that's what I do know, and that has a major impact on local currencies, the GDP, and the jobs outlook. But besides that, I would say that a lot of analysts focus on U.S. inflation because that impacts how the U.S. central bank is going to react to this, and same thing with China. But in terms of how that plays into emerging markets around the world, I'm not necessarily an expert in that area. And so generally speaking, what I do know is that there's a big impact on currency between that emerging market currency and the USD. There's impact on local GDP, and monetary policy in emerging markets have been more hawkish. But beyond that, I don't really want to comment as much because that's not an area where I consider myself an expert.
Okay, thank you.
Okay, Mr. Cheung, finally, we have a question that someone asked me to translate it for you. So it's from Maria Fernanda, and she's asking whether, give me a second. she's asking whether the economies of China and Russia be more integrated, given now that there is a geopolitical, well, given the actual geopolitical situation, the US and the West is trying to isolate Russia, so China is not taking like a stand for either side. China is just stepping out of this one. So she's asking, will those economies be more integrated further on?
That is an excellent question. And a lot of analysts and economists are trying to figure out how that will play out. I would say it all ties back to a very important press conference meeting that President Xi and President Putin had sometime around the Beijing Olympics, and they discussed that their partnership and their ability to collaborate with each other had no limits. And that was a really important press conference that President Xi and President Putin had together during the time of the Beijing Olympics. And they expressed in spirit that they are willing to support each other to, I would say, be more competitive against the West, broadly speaking. Now, in terms of whether China is going to execute on that action, I do believe that President Xi has in his interest to see the Russian-Ukraine situation play out in a way that benefits President Putin. I do think that if the Russian economy runs into trouble, that it's possible that China is going to fill the void, provide financing, provide trade resources. I do believe that they will be more integrated. That said, I know that this is a very tricky situation because the more China moves in that direction, the more they will have tensions against the US. So this is an area that I'm closely following from a political perspective. It's been publicly said that the two presidents, President Xi and President Putin, are going to work together. And I do believe that if Russia needs help with financing and needs help with trade, China will help there. But I also want to caution against the fact that, like, if China is too public about it, then they risk potentially not having like a strong trade relationship with the US. And so it's a very delicate situation that China and Russia are going through. I do believe that China will help President Putin, but I don't believe that China will totally isolate the West as well. So it's a very delicate balance, and I hope that answer helps, because it's a constantly changing situation. Like, the sentiment around this could change week over week, but that's where it is right now, I believe.
Okay, thank you. But I'd like to just ask you one more question. It has to do with this dealing China-Russia. Do you think China will take an advantage of that oil coming from Russia that cannot be exported through Ukraine given the current war?
That is a question I can't comment on that.
Okay, no problem. But well, that will be all. Thank you very much for coming here, for giving us this conference, Mr. Cheung. Hope you like it. We surely did. So thank you very much, and we'll catch up in the next one.
Okay, well, thank you, and have a great day, everybody. Thank you for having me.
Sure. Have a nice day. Thank you. Goodbye.